So one, I think that cycles can change shape over time. So
Hmm.
as we enter a more institutional phase, on average, I think we'll see a little bit less euphoria, but then potentially also a little bit less downward volatility, because you're not coming off of that level high of euphoria.
Hmm.
So when I look at metrics like market capitalization to on-chain cost basis, and so far we're nowhere near the peaks that we generally reached in say 2021, 2017, 2013, kind of those major multi-year tops. So this cycle has kind of been characterized by, pretty strong upward moves, and then maybe a 7 month consolidation, and then another significant upward move, and then another 7 month consolidation. I think that's a healthier market overall. Currently, we're in another consolidation. I wouldn't be surprised to see it continue for a couple more months.
The cryptocurrency market is changing, but not in the manner that most people anticipate. The days of violent surrender and crazed joy fueled by shopping are long gone. They are being replaced by something much more substantial, a stage of institutional maturation when the highs are less erratic and the lows are less catastrophic. However, one thing doesn't change in spite of this shift in personality: the capacity of Bitcoin to perform better despite pressure from the macroeconomic environment. Few experts have been able to catch the subtleties of this change as well as Lyn Alden, a macro strategist who is highly regarded in both the Bitcoin ecosystem and institutional finance. Alden makes a bold but calculated assertion in her most recent evaluation: the top is not us. This cycle hasn't even reached its full maturity yet. Market capitalization to on-chain cost basis, in particular, remained far below the peaks observed in previous cycles such as 2013, 2017, or 2021. She contends that we are currently going through another phase of sideways consolidation. Furthermore, these periods of consolidation are not the end. If history is any indication, their upward motions are explosive. Is not the foundation of this thesis? According to Alden, structural factors are working in Bitcoin's advantage. The United States is currently experiencing fiscal supremacy, enormous deficits, growing debt servicing expenses, and political resistance to reducing entitlement expenditures. This causes difficulties, reduced margins, increased tariffs, and input cost shocks for conventional enterprises. However, it's a tailwind for hard and unyielding assets like gold and Bitcoin. Neither price elasticity nor input costs affect these assets. They have no debt, and they prosper when currency assets are steadily declining in value. According to Alden, Bitcoin is among the most liquid and quick horses available on a large scale. It is becoming more institutionalized, rare, and additionally, this cycle differs from others in that it features quick rallies, multi-month consolidations, cleaner stair-step growth patterns, and then another leg higher. We're not only in the midst of one of these consolidations, claims Alden, we may be getting close to the start of the next leg. We dissect her entire macro argument in this video, covering everything from fiscal domination and structural deficiencies to why altcoin treasuries might be the biggest warning sign as of yet. Please share your ideas by liking, subscribing, and commenting below, particularly if you think that current consolidation is only the quiet before a new breakthrough. Let's get started.
I don't really have any strong view on near-term trading. Probably my recent orange flag or yellow flag was the rise of these altcoin treasury companies. That's kind of a sign of froth in the market. Combined with, I previously mentioned maybe some of these economic deceleration risks over the next couple months. So I wouldn't expect to see a little bit more consolidation in the months ahead. But I do think we have probably at least another stair step up, like we've seen a couple of these this cycle, hopefully more than one. But I still think we're headed higher in terms of this kind of upward move and then consolidation and upward move consolidation. I still think we have more fuel this cycle. The real rates one. I do think there's a fundamental shift, and people said the same thing around Bitcoin. They were like, Bitcoin's a zero rate phenomenon. It won't do well when you have high rates, and here we are at high rates and Bitcoin six figures, and gold, comfortably well over 3,000. Um, what changed was that we entered fiscal dominance. And so when you have pretty low public debt, and most of the money creation is coming from bank lending, when you raise rates, you generally slow down bank lending at a bigger degree than you blow out the deficit. On the other hand, when you have over 100% debt to GDP on the public sector, and most of the inflation is coming from monetized fiscal deficits, not from excessive bank lending, when the Fed does what they're doing now and they raise rates and try to keep them high, they actually blow out the fiscal deficit by a bigger number than they slow down bank lending. So they don't, for the most part, they don't greatly slow down total credit growth in the way that they're trying to. So basically, when they sharply raised interest rates in 2022, that temporarily brought everything down. But then as soon as we started to get some of your treasury offsets, we started draining the reverse repo facility. We were not really, even though the Fed was remaining hawkish around the margins, a lot of conditions were still improving at that point. And that's generally a sign of fiscal dominance, that even high rates don't really do what they used to do in terms of slowing things down. Sometimes they just add fuel to the fire. And so I think that's structurally what changed this cycle. And I think that's a more persistent regime that we're in now. That's not even a near-term thing. That's just kind of structurally the environment that we're in now. And so there's still be correlations where if the dollar goes through a strengthening period as it has, in recent weeks, that can put downward pressure on gold and certain other assets. But in the grand scheme of things, I think that correlation, that interest rate correlation, is severely reduced now, and it's more about what's happening fiscally. How independent is the central bank perceived to be, and factors like that more so than just that interest rate correlation. It's In worked out terms well for of the past raw five return years, potential, just I'm more because bullish on gold's Bitcoin a 20 and trillion that's plus asset, Bitcoin's a 2 trillion plus asset, and I think that Bitcoin being a 16-year-old asset, it's basically gold combined with a tech stock. It's growing into whatever total addressable market it's going to reach, whereas gold's already closer to its total addressable market. So, in exchange for basically more tail risk, more volatility, Bitcoin comes with higher returns. And so, on an absolute basis, I expect better Bitcoin returns than gold returns. But the way that I generally characterize it is because I've been a bond bear, I basically said if you take a 60-40 portfolio and think how can I improve it for a period of fiscal dominance, well, one, you can take out some of the bonds and replace that with some gold for starters. And then you can take out some of the equities and replace it with Bitcoin. So I generally don't really view them in competition. I just generally view them as different, replacing different parts of the portfolio. I think gold is more of uh, it's more of a competition for bonds, and Bitcoin's more of a competition for some of the higher volatility parts of a portfolio, such as equities.
Lyn Alden's ability to connect long-term macro trends with practical investment advice is what distinguishes her perspective. Over time, her nothing stops this train argument has only become more pertinent. She cites war spending, entitlement, programs like Social Security and Medicare, the structural deficits built into the U.S. budgetary framework, and the current skyrocketing interest payments on the nation's debt. These are not short-term measures that change every election cycle. They are enduring elements of the terrain. Alden contends that the entire cost of debt payment has entered a new, structurally higher, and increasingly unavoidable regime, even in the event that the Federal Reserve is able to modestly lower short-term rates. This fact is naturally inflationary, and it is extremely motivating for monetary hedges like gold and Bitcoin. Nevertheless, Alden is aware of the new challenges that are coming into the macro picture. The most significant of these is the reintroduction of an aggressive tariff policy, especially during President Trump's second term. Alden notes that current tariff rates are still equivalent to those that caused market stress in April, notwithstanding recent attempts to portray tariff talks as agreements or However, equity markets are ignoring it and rising to all-time highs with minimal anxiety and tight credit spreads. She contends that this gap is harmful. Before the tariffs went into force, many importers front-loaded purchases, generating a short-term buffer that has postponed cost pass-through to customers. However, that window is rapidly closing. Even though the United States has already received over $150 billion in tariff income, the true cost to American consumers and businesses is just now starting to become apparent.
So I don't think it'll snap back. And to the extent that it snaps back a little bit, it's potentially higher employment. But basically, um, the biggest reason for that, number one, is demographics. So we started to enter an older demographic period, and because our economy has a pretty extensive entitlement system, that means more people drawing from Social Security and Medicare than paying into it, and so that increases our deficits even at a time when we have low unemployment. And in addition, we ended a 40-year structural period of declining interest rates. And so for many years, we had rising debt to GDP, but that was offset by falling interest rates. So it kind of kept interest expense manageable. But now when we enter a period, even if interest rates are not structurally rising, if they're just kind of in a choppy range now, so if you're not falling from like Volcker era all the way to zero, if instead you're just kind of bouncing between 2 and 5 for the foreseeable future, let's say, you no longer have that offset, even as you're running pretty significant deficits. And so the combination of higher interest expense and more seniors drawing from the entitlement system, that puts just more structural strain on fiscal deficits. And to the extent that we do get a uptick in unemployment, generally speaking, you should expect that the fiscal deficits to also probably widen to some degree. So it's pretty hard for those alligator calls to close anymore, and that's partially why. I mean that's fiscal dominance in a nutshell. That's basically that is a different investing environment than people are used to for the past 40 years. So I don't think it's the only thing. I think it's one of the fastest horses available at scale with liquidity. So structural bull on Bitcoin, but also, I mean, gold over bonds is generally a beneficiary of fiscal dominance. Um, Equities at reasonable prices is also generally a beneficiary of these situation. I talked about strategy, formerly MicroStrategy. A company that holds Bitcoin which is scarce, and then they issue various credit instruments denominated in the currency that's, we're running away in terms of fiscal dominance. So they put their liabilities in things that are debasing and their assets in terms of things that are scarce. And as long as they manage that conservatively through the various ups and downs and volatility cycles, they benefit. Even part of the reason why traditional equities can do well is because a lot of equities like locked in 5, 10, 20, 30-year bonds at super low rates, um, and bought back shares, and they still have a lot of those bonds outstanding. So their liability side is locked in and gradually getting inflated away. And the ones that have pricing power can keep ratcheting up their prices, um, and keep doing pretty well. So generally speaking, anything that has some degree of scarcity, whether it's an economic moat for a business or pricing power, or it's literal scarcity like gold or Bitcoin, is generally well positioned for fiscal dominance outside of kind of localized overbought bubbles that show up from time to time. And then anything that can attach a short of fiat currency to those things generally adds fuel to the fire as long as it doesn't get over its skis. So I don't have an opinion on who. I have an opinion that it'll be more of a dovish, more of accommodative
Hmm.
appointment, based on the president and the current makeup of Congress. Um, and my general expectation is that, by 2026, we'll probably have lower average interest rates. It's important to note that the Fed chair is not a unilateral decision maker. It's a committee.
Sure.
Um, but overall, I think basically we'll be in a generally more dovish position. Um, Long end rates, like I said, maybe sideways. That's more of a trading question of what's going to happen in any sort of 3 to 6 month period. But it's important to keep in mind, and generally in recent kind of discourse, I see this often mixed up, that just because the Fed cuts rates doesn't necessarily mean that, say, mortgage rates go down or long end treasury rates go down. And so you could see them cut rates and the yield curve steepens just by them staying roughly where they are. And so my general base case is mildly lower short-term interest rates over the next year or two, um, flat and choppy longer in rates, depending on what happens with tariffs and what happens with any sort of unexpected shocks along the way that I'm sure we'll discuss in later discussions we have together. There's never kind of a shortage of things to talk about. Um, uh, One of I think the key things worth pointing out is that we're probably not going to get a really big housing refinance cycle this time. So generally speaking, when you do get a rate cutting cycle, especially when longer end rates do go down due to some degree of kind of economic slowdown, one of the silver linings is that homeowners can refinance their mortgages, um, and basically get a free lunch. And the problem is that I don't think we're going to get a lower low in mortgage rates, which will generally limit how much refinancing volumes happen. And it'll mostly be limited to people that unfortunately kind of locked in higher mortgage rates, kind of in 2022 and beyond. And those people can get potentially a little bit of a, uh, ability to refinance, but that'll be a much smaller burst than we're used to. And therefore, especially combined with tariffs, I think it'll put some pressure on the consumer. So I generally think that we're in more of a malaise going forward. So it's not doom and gloom, um, but until I see signs that say otherwise, I think we're in a little bit of a pretty range bound period in terms of economic performance And then my guess would be also top line equity performance, but we'll see.
Lyn Alden's perspective is an essential contrast to the complacency represented in headline equities indices as the U.S. economy moves toward a period of greater vulnerability. She issues a mild but important warning. Although the overall market could seem sound at first glance, the basic principles are changing. Although structural budget deficits still exist, historically high tariffs that act as a covert tax on production and consumption are now offsetting them, at least in part. This friction affects more than just US growth. It changes how capital allocation is played out. In that new setting, assets that are resilient and scarce like Bitcoin chiefs stand to gain from a profound structural realignment. In addition, to investor fervor, speculation, or short-term price targets don't influence Alden's opinion. According to her, Bitcoin is a resource that is especially well suited for fiscal domination, a monetary system where traditional mechanisms like rate hikes are becoming less effective and government spending greatly outpaces tax revenue. As macroeconomic distortions worsen, Bitcoin's value proposition becomes more compelling than that of stocks, which are based on company profits, or bonds, which are based on suppressed interest rates. Furthermore, her long-term conviction is evident even though she is cautious in the near term and anticipates that this consolidation phase will continue. The cycle continues. The most potent move might really still be coming. If you were as impressed with Alden's analysis as we were, please remember to like, subscribe, and leave a comment below with your comments. Do you think there is still energy in this cycle, or are we about to hit a macro wall? We'll go over this train's entire journey. Thank you for watching, and keep checking back.